Hi, I'm Carrie Stacy from Stacy International. I'm a CPA, a CVA, which is a business valuator, and a CPA in Canada. Today, we're going to talk about, I specialize in helping dealers sell their dealerships, do business valuations for all purposes and all types of valuations. And they do a little consulting to help dealers get their dealership results where they want them. You've heard a lot about cash flow this, cash flow that, cash is king. Well, what is cash flow? So let's just go through a quick little example and find out what cash flow is all about. Cash flow is the amount of money you can take home at the end of the year. That's it. How much cash can you take home at the end of the year? How much is left after paying everybody, after getting it done? So the best way to look at cash flow is with an example. So let's start with two different dealerships, both about 10 million in revenue, both have $700,000 bottom lines, which is 7% of revenue. So remember that the way we measure net income is as a percent of revenue, or cash flow. So I've pulled out 4 expenses that would be in these dealerships' financial results, and we're going to look at those and do a little work on them. It doesn't add up. We've just pulled these out for illustration purposes. So first, we're going to normalize their income, because everybody, if you have a good accountant, they're driving that bottom line to be just enough to pay a little tax, but enough to keep the IRS from wondering what you're doing and looking at you with a microscope. So what we want to do first is find out what your actual cash flow is, what your expenses are necessary to generate the ongoing revenue that you're presenting. So let's talk about vehicles. The ones I've chosen to show are very, very common in almost every business I look at, and I look at hundreds. These are common issues. So lots of people put all their family's vehicles through their business, and you need, in a dealership, you need at least 1 or 2 shop trucks, depending on the size of your enterprise. But maybe you have your wife or your kids or your own personal vehicle is running through there as well. Or you have a vehicle in there that's used a little for business, but not most of it. So the first thing we do is we add that difference back in company A. We're going to say that 25,000 is about the necessary expense, and the difference is discretionary. So all of these expenses would be tax deductible. That's not being discussed here. What we're trying to identify is what the actual cash flow that your business is generating to an owner. How you spend that, whether you buy extra cars in your business, that's up to you. Tax deductible is just fine, but we want to be able to show what that actual cash flow is. So we've adjusted vehicles to market rates. So we're adjusting necessary expenses to market rates, adding back discretionary expenses. Next, let's talk about owner wages. In our scenario, the owner is the general manager, and he is working in the business every day. And we're going to say $150,000 is market wage for that work. So we've deducted that $150,000 in company A, no adjustment to company B. So look what's happened to his net income. It's dropped significantly. Now he's at a 5.75% of revenue. So that percentage of revenue, the target range, and lots of you already know this, should be between 5 and 10%, trending towards 10%. And lately, lots of dealerships are over 10%. So this guy is now starting to struggle. If he paid himself market wages, he'd be starting to struggle a little bit. All right, let's go on. Company A, again, what's the market rate for the cost of the premises? In company A, we're assuming that they bought their land a long time ago, they own their facility and it's paid off. So there's no rent, there's no mortgage costs. So we need to deduct a market rate. And why are we doing that? People say, well, it doesn't cost me anything. Well, when you're valuing a business, or when a buyer's looking at it to buy it, or a banker's looking at it to lend on it, there is a cost of occupancy. So if somebody else takes that over, or they're going to have debt service costs, mortgage payments. If you sell your business but keep your land, you're going to lease it to the new owners. What's that lease going to be? And if a lender's lending on it, you're going to have mortgage payments, right? So what's that going to be? So we're going to say that's now down to, we're going to say that $250,000 a year is market rent for this, these enterprises. And look what that does to the bottom line. Now, company A, not only at the bottom, he's really struggling. If he were to pay himself market rent and market wages, he would be really struggling. So we're evaluating how this business is actually doing when it has to pay market rates for everything, and it's struggling. He is having sleepless nights at 3.25%, and if he has, a bad season, he's going to be, the stress level is going to be through the roof. Remember, the target is 5 to 10% of revenue. So that's how we get to a normalized net income. There you go. 3.25 for him, 7% for the other guy. This guy's okay. He's doing fine, and he's making money. So now we've normalized net income. What is cash flow? Is cash flow net income? Yes, in some, it's where we start from. But cash flow, we're looking at, your income statement includes non-cash expenses, and depreciation is one of them. Most of the time, it's the only non-cash expense in privately held businesses. But think about it. You don't actually put money down every year for depreciation. So there's actually $100,000 of more cash coming in from that $10 million. So cash flow from company A is actually 425. Cash flow is actually 800. So net income is 325 and 700, and cash flow is net income plus non-cash expenses. All right. So the example, just a footnote, this is a very simplified example for illustration purposes only. Sometimes there's a little more to it than that. So what's the jargon we use to talk about cash flow? The most common you'll hear is EBITDA, and the definition is in the name: earnings before interest, tax, depreciation, and amortization. So before tax, so you're looking at your pre-tax income, you're adding back depreciation, which we just did, and you're adding back any financing type interest that a buyer wouldn't have to pay. So if you are have some personal loans that financed your acquisition of the business, that goes away when you sell your business to someone. So they're adding that back to get EBITDA. That's simple. It's commonly used by investors and bankers who are looking at how the company's doing after paying everyone market rates for what they do and removing the discretionary expenses, of course. The other one you'll hear bantied around is seller's discretionary earnings, or just discretionary earnings. And that's for people who are looking at it with an eye to being the active owner manager working in the business. And that's a measure of how much cash that owner will take home in total. So you're taking that EBITDA and you're just adding the owner's salary. That's it. Now you know everything about cash flow. So I want to talk for a minute about the company A situation where he wasn't paying himself a market wage or a market rent. This is, if you take one thing away from this video, take this. In almost every single business I see, and I see hundreds, where the owner is underpaying himself or underpaying his rent, the business is underperforming, just like our example. And that's fine. You go along thinking you're doing just fine, and maybe you don't need the money to live your life. But when you go to sell or when you go to borrow, the heartache of finding out that you're underperforming and the implications of it are catastrophic. By the time you go to leave, if that example, company A, the owner had died and the family had to dispose of that business, they would get significantly less for it. Bankers are going to say, you're really not performing very well. And they're going to have a tougher time lending to you if, say, you want to restructure your debt or you want to expand or acquire something else entirely. They're going to look at this and they're going to do a valuation on it. And they're going to say, well, we're really not making any money. So to make businesses comparable and evaluate their debt paying ability, these amounts are adjusted to market rates. So pay attention to it starting today, because it will influence tomorrow. And in many cases, your personal tax plan is such that you don't want to pay yourself market because you're getting income from over here or over here, and it will just wreck your tax plan. You'll pay too much to the government. As well, I understand there's rent tax in Florida. There are probably other states like that. I'm not a state tax expert. In those situations, you don't want to charge yourself market rent. You don't want to charge yourself market wages. So what I recommend is use a journal entry every month to make that difference up. Put a number on it so that you call it overhead allocation, call it something nondescript that no one's going to care about other than yourself, to make up that difference so that when you're looking at your results, you've got an eye to saying, okay, they're too low. What do we need to do about it? It will force you to make better decisions at the top and every single day of your business life. What I see is all of a sudden, if they don't have to pay rent or they don't have to pay wages, all of a sudden that bottom line looks like the same number of dollars. So they feel like they're doing great. So they start to let their gross margin slide. Well, I can give a guy a discount. I can throw in a barbecue. I can do a little extra work on his boat for free. And all of a sudden, all these other things start to go haywire. I can pay my guys more. I can throw out bonuses. I can, let's get some extra tools. Let's have Pizza Friday, make it the premium pizza. Let's do some fun stuff. Let's all go on team building outings 3 or 4 times a year. All those great things that you want to do, but generally businesses have to limit. All of those expenses get a little bit bigger, and it's catastrophic. I want to show you. So let's look at these two businesses now. Company A is underperforming. So their multiple is going to be lower than company B. People are going to want to get a better deal if they buy this because they got to fix it. And that's hard work. And nobody likes to see somebody come in and start saying no to spending, or you got to get more margin. So it's tough. So that multiple falls. People will pay less for a turnaround situation. So let's say we got a multiple of 2 for company A, makes this business worth $850,000. Company B is right in that margin at 7%. Pretty good. It's not fantastic. It's pretty good. So let's say we've done a bunch of research. We've looked at the other risks and other factors in his scenario, and we come up with a multiplier of 2.75. Well, 2.75 on 800,000 is 2.2 million. So take a moment and look at how that difference has impacted these dealers. This one, both are $10 million businesses. Somebody's paying this guy $1,850,000. I'm rounding to $1 million. This guy's going to get double that. It's a big deal, and I see it every single week. I get a set of financial statements where they're not watching that bottom line for one reason or another, and the difference is staggering, and the heartbreak is wrenching. Having to tell someone, your cash flow is half of what it could have been if you started 5 years ago, tightening your belt and watching what your margins. So please, if you take one thing away, watch that bottom line as a percent of the top line after paying market wages for all of the work that's done, market rent, and after adding back those discretionary things. So those are the happy ones when we add back, your teenage son's $50,000 a year salary for showing up once in a while to sweep the floor. Those things are the positives, but those where you're underpaying yourself where you're underpaying yourself rent and wages, it's never a good story. So please, please, please take this story home and take care of your business. Need any help? Give us a shout. We do benchmarking once. We do monthly benchmarking or monthly, quarterly, or annual benchmarking, all of it with recommendations. We can partner with you through your turnaround if you're working on a turnaround in your business. And we do all sorts of other things to help people create pay plans that get everyone pulling in the same direction. So thank you so much, and enjoy the show.